Have you ever felt that nagging pressure? You know, the idea that to really succeed in the market, you need some kind of financial guru.
Mm-hmm. Someone with a secret formula, maybe?
Exactly. An investment genius, someone with a crystal ball. We see headlines all the time, right? Hot stocks, expert predictions, promising these incredible returns.
They're everywhere.
But what if I told you that chasing that guru, that single genius, might actually be holding you back?
That's a really powerful point. Because the conventional wisdom, this idea that you need a genius or some super complex formula to navigate the markets, well, our sources suggest it's largely an illusion.
Okay.
So this deep dive is all about unpacking exactly why simple, rule-based investing often beats those flashy predictions and really complex strategies.
Right.
Our mission today really is to show you that getting rich isn't about finding a genius. It's more about embracing, well, common sense and discipline.
And to guide us through this kind of anti-guru journey, we've pulled insights from some real titans of the financial world.
Yeah, some heavy hitters.
We're talking about the profound wisdom of John C. Bogle, the founder of Vanguard, and Benjamin Graham, who's widely seen as the father of value investing.
Their work provides this really solid counter-narrative to that guru obsession we see.
It challenges a fundamental human tendency, doesn't it? Believing that past success automatically predicts future success in investing.
Absolutely. And that assumption is, frankly, deeply flawed,
Yeah.
especially when you look at actively managed funds.
Okay, let's really dig into this guru paradox. It feels so intuitive, though. If a fund manager has had an amazing run for years,
You think they've cracked the code?
yeah, you naturally think, okay, they've got the secret sauce, they'll just keep winning. But our sources highlight this powerful thing called reversion to the mean. What does that actually mean for these star performers?
It means that funds that do exceptionally well in one period, they tend to regress. They often fall back towards or sometimes even below the market average later on. Think about the famous case of Legg Mason Value Trust. This fund outperformed the S&P 500 for 15 years straight. 15! From 91 to 2005.
Wow, that's incredible. That sounds like proof of genius right there.
It really does. But what happened next?
Uh-oh.
Well, from 2006 to 2008, it fell behind the S&P 500 by, get this, an astonishing 43 percentage points.
43 points. That's a massive swing.
It's a staggering reversal. It tells us that even really sustained past success just doesn't guarantee future outperformance.
And it's not just single funds, right? Even those star rating systems like Morningstar ones everyone looks at.
Yeah, the five-star funds,
Turns out they have surprisingly little predictive value.
very little. The research shows, and this is almost hard to believe, that if you bought five-star funds when they got the rating and then sold them when they lost it, you'd actually end up with below-market returns while taking on above-market risk.
That's completely backwards from what you'd expect.
It truly is. It strongly suggests that a lot of what looks like skill in active management might just be, well, random chance, or maybe a temporary fluke.
The market just kind of pulls everything back to the average over time.
It has a powerful tendency to do that, yes, which makes it incredibly hard for anyone to consistently beat it, especially if you factor in costs.
Costs. Okay, let's talk about those. Because they're like these silent killers of your investment returns, aren't they?
They really are.
Many investors just don't realize how significant these hidden and visible costs are for actively managed funds and how much they erode your gains. What are the big ones?
Well, a primary culprit is often high portfolio turnover.
Meaning lots of buying and selling within the fund.
Exactly. Our sources reveal that many fund managers engage in really rapid turnover, averaging maybe 80% to 85% annually for U.S. equity funds.
80%. That's huge.
It is. Compare that to the 60s and 70s when turnover was closer to like 8%. These managers are often acting more like short-term speculators.
Not long-term investors holding on to good companies.
Precisely. And that churning, that constant buying and selling, is inherently expensive.
How so?
Well, two ways. First, all that activity incurs what we call hidden transaction costs. Think brokerage commissions, bid-ask spreads.
Stuff you don't easily see.
Right. And these can add maybe 0.5% to 1.0%, maybe even more, to the fund's actual expenses. And that's on top of the expense ratio they advertise.
And those expense ratios themselves aren't trivial. The average for equity funds is what, around 1.5%?
Yeah, around there. And the highest cost ones can hit 2.2% or more. Now compare that to the lowest cost funds, often index funds,
Which are down around 0.2%.
or even lower sometimes. It's a massive difference even before you add in those hidden trading
Right,
costs.
so when you put the expense ratio and the hidden transaction costs together.
You get what Bogle called an aggregate fiscal drag.
Mhm.
And this drag can silently eat up, say, over 3% of your returns every single year.
Wow, so if the market gives you 10%.
Those costs could be taking almost a third of it right off the top. It's like a persistent, silent leak in your investment bucket.
That's astonishing. And beyond just the costs, there's another trap Graham warned about, right? This lure of quick fix strategies, the formula to fiasco.
Yes, people trying to exploit some perceived market pattern with a trendy formula, thinking they've found the secret key.
Like the January effect.
That's a classic example. The idea that small stocks tend to pop early in the year. It got really popular.
Hmm.
And then as more people tried to jump on it, the effect just kind of withered away. The market's pretty good at neutralizing these secrets once they become common knowledge.
Which brings us back to Benjamin Graham and his skepticism about projection. Forecasting future results, he called it a fool's errand.
He did. He even suggested expert forecasts are often less reliable than flipping a coin.
That's bold. Why was he so down on forecasting?
He argued that the more complex the math got, calculus, higher algebra used in these sophisticated models, the less dependable the conclusions actually became.
Really? More math made it worse.
In his view, yes, because it often just disguised speculation as sound investment. He believed reliable calculations for stock values rarely needed more than simple arithmetic. Anything more complex was often substituting theory for experience.
Okay, so if complex predictions, guru worship, chasing formulas, if that's all a fool's errand, what does work?
Well, this is where the power of simplicity and protection comes in, championed so well by both Bogle and Graham.
Right, Bogle's common sense principles seem so straightforward.
Deceptively simple, almost. He famously said, "The secret of investing is, finally, that there is no secret."
I like that.
He also stressed, "Invest you must." He argued the biggest risk isn't short-term ups and downs, the volatility, but the long-term risk of not putting your money to work, not earning a potentially generous return over time.
And he also said, time is your friend, start early, even small amounts, because compound interest is a miracle.
It truly is.
Eh.
But conversely, impulse is your enemy.
Ah, the emotional side.
Exactly.
Yep.
Eliminate emotion. Have rational expectations. Don't change your whole strategy just because the market had a bad month or a good month. Stick to the plan.
Which really highlights what you mentioned earlier, that tyranny of compounding costs. How small cost differences blow up over time.
They lead to staggering differences. The source material has some really dramatic examples that bring this home.
Let's hear one.
Okay, imagine you invested $10,000 back in August 1982. If you put it in a low-cost, all-market index fund, total cost just 0.2%.
Yeah.
By the end of the period studied, it could have grown to over $153,000. That fund captured about 97% of the market's total growth.
97%. Wow. Okay, now what about the same $10,000 in a typical actively managed fund with average costs?
That same $10,000, it would have only reached about $113,700.
Oof, that's almost $40,000 less.
Exactly, capturing only 70% of the market's growth, almost entirely due to the drag of higher costs compounding over decades.
And does that hold true even if market returns aren't stellar?
Yes. In fact, the gap can widen proportionally in lower return environments. Say the market returned 8% over 15 years. The $10 K index fund becomes maybe $30,900. The managed fund, only $24,000. The index fund still gets 96% of the market growth, but the managed fund share drops to just 64%. Costs eat a bigger slice of smaller gains.
And then there are taxes. You mentioned active funds are often tax inefficient.
Highly so, because all that high turnover, that buying and selling,
It's capital gains.
right, which get distributed to you, the investor, and you have to pay taxes on them each year, even if you never sold a single share of the fund yourself.
How do index funds compare on taxes?
They're inherently tax efficient. Why?
Yeah.
Because they have super low turnover. They mostly just buy and hold the stocks in the index.
So fewer taxable events.
Far fewer.
Mm.
Over 15 years, one study showed the Vanguard S&P 500 index fund beat 94% of its peers before taxes.
Yeah.
But it beat an incredible 97% after taxes.
So the tax advantage is significant.
It really is. Taxes are often called the black sheep of the fund industry because managers don't like to talk about them, but they make a huge difference to your actual take-home return.
This really brings us back to Graham's idea of protection over projection. His core principle seems foundational here.
It is. He said, a stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business.
Right. with an underlying value that does not depend on its share price.
Exactly. And that insight lets you see past the daily market noise, the emotional swings.
Graham described the market like a pendulum.
Yeah, a pendulum that forever swings between unsustainable optimism and unjustified pessimism.
So the smart investor,
Is a realist who sells to optimists and buys from pessimists. They don't get swept up in the euphoria or the despair.
that's a critical mindset shift. So for you, the listener, how should you view those constantly changing stock prices?
Graham's advice is clear. Don't buy just because the price went up, or sell just because it went down. He said, market quotations are there for your convenience, either to be taken advantage of or to be ignored.
They're a tool, not a command.
Precisely. A tool, not your master.
And this thinking leads directly to one of the most practical tools for most people,
Yeah.
broad diversification through indexing.
Yes. Graham himself said that for most investors, the ideal choice is a total stock market index fund. He called it a low-cost way to hold every stock worth owning.
It gives you that broad diversification without needing the impossible task of picking winners.
Absolutely. So when you're building your own sort of anti-guru toolkit,
Yeah.
a key takeaway is focus on what you can control. The sources emphasize that the return you should expect depends on the intelligent effort you're willing to put in.
Not just how much risk you're willing to take.
Right. It's about smart, disciplined decisions, controlling costs, staying diversified, being patient, not high-stakes gambling or relying on someone else's guess.
And the simplicity of indexing just nails that principle.
Yeah.
Index funds were once called Bogle's folly, weren't they?
They were. Critics scoffed. Now they're hailed as the hallmark of responsible investing. They're clearly here to stay.
Because they reliably match the market at much lower cost and risk than most active funds.
Consistently. So some practical rules of thumb coming out of this deep dive.
Let's hear them.
First, prioritize low-cost funds. Seriously low cost. Aim for expense ratios under 0.5% for bonds, maybe even lower for stocks if you can. Low cost is one of the best predictors of better long-term returns.
Okay, number one, low costs. What's next?
Second, embrace long-term investing. Don't chase trends. Don't try to time the market. Let the cycles run their course. Trust the power of compounding over decades. It's about patience.
Patience, not prediction. Got it.
Third, think about asset allocation. It's a wise starting point. Maybe gradually reduce your stock percentage and increase your bond percentage as you get older to manage risk.
And bonds do help cushion downturns.
They generally do. They did their expected job at moderating risk during that nasty 2007-2009 crash. They provided stability, sometimes even positive returns, when stocks were cratering.
And one final point about structure. You mentioned organizations like Vanguard operate differently.
Yeah, it's interesting. Because Vanguard, for example, is structured, essentially owned by its funds, which are owned by the investors, there's no outside profit motive driving up costs. This gives them an inherent edge. Because they operate at such low cost, they can afford to go the extra mile for their investors in terms of service without compromising that cost advantage. You really are treated like an owner.
So wrapping this up, the message seems pretty clear.
I think so. Sustainable wealth isn't built on finding that one guru or using some complex secret strategy to outsmart everyone else.
No.
It's built on discipline, low costs, thinking long-term, and being broadly diversified. That tyranny of compounding works powerfully against you with high costs.
But it works just as powerfully for you with low-cost investments held for the long haul. So maybe the real secret to getting rich isn't about finding a genius after all.
Maybe it's about realizing you don't actually need one to begin with.